The Rebel Capitalist Show.
It's above my pay grade, but what's going through my head right now that I'd love to get your opinion on is if you had a situation in the United States where the U.S. Treasury market traded or didn't trade like the JGB market, how does that work with the U.S. dollar funding markets, more specifically the repo market? I mean, it seems like it would just blow up.
It would, because, keep in mind that there is something like $800 billion of currency in the world, the actual physical bills.
Right.
But the amount of cash, or the things that we think of as cash, is many, many times that. So what we do is we use the government bond market, the treasury bill market, and the like as a cash substitute. So that anytime a big company needs to send another big company $1 billion, they don't send them a pallet full of dollar bills.
Right.
They wire them treasury securities. So we use them as cash substitutes. And as long as there is a vibrant liquid market, we could create derivatives off that market, like repurchase agreements and the like. When the volume of those was to shrivel up and go away, and the only reason that would happen is if by government fiat we set the wrong price, those markets would become dysfunctional. You would either be perceived as, like I said, the price is too high and I want to buy it, but nobody wants to sell it to me. Or the price is too low and I want to sell it, but nobody wants to buy it. But in a free market, the price should always be somewhere near equilibrium so that I can attract buyers and attract sellers and transact at some point. If you don't have that, the plumbing of the financial system, the ability of large institutions like financial institutions to send cash back and forth to each other, to balance their books, starts to become a problem. Our financial system is not structured that way. It won't work properly if we wind up having the markets go in that direction. Now, let me say, well, a lot of people at the Fed, if they're listening to this, they'll say, yeah, but we're doing this in an emergency. And then when the emergency passes, we'll back off. Jim, I agree with you that if we did this too much, it would become problematic.
Yeah, that's QE1 right there.
Right, QE1. We're in year 13 of QE1 that morphed into 2, 3, 4, and everything else. It never went away. Furthermore, let me give you another sobering statistic, since I'm Johnny Raincloud on this interview here. Larry Kudlow said that to date, the total amount of Fed printing and borrowings or promised borrowings from the government is $9 trillion. Earlier this week, the Democrats put up a bill for another $3 trillion. That's $12 trillion. Let me put that number in a different perspective. That is approaching 4.5 years of income tax receipts. So in the space of 2 months,
wow,
we said, here's the problem. We're going to just whip up 4.5 years of income tax receipts to solve this problem. We're either going to print it or we're going to borrow against it. Now, if you are an optimist, a government optimist, we're going to do this. We're going to support the markets. We're going to support everybody with a job. We're not going to produce inflation. We're not going to produce malinvestment. Let's just suspend reality and think you're not going to produce inflation and or malinvestment. Why would you stop? Why would you stop after the problem is over? This is MMT, Modern Monetary Theory 1.0 is what this is. So if you do it and there isn't a toxic reaction in bad malinvestment or a plunging dollar or rising inflation, which
why are we going to work, Jim?
What?
Why on earth is anyone working?
Well,
that
was what I was going to lead up to.
Just print the money, give it to everyone. If there's no negative consequence to money printing, what are we doing working? We're just a bunch of saps.
Right. Or what I was going to lead up to is, why are we even paying taxes anymore?
Yeah.
Because if you can print up a year's worth of taxes, our taxes are not due until July 15th. And there's already stories I'm reading that they may push that off until December 31st. That in Chicago, my real estate tax bill, they just passed, which is normally due in the first week of August. They said, no, I could pay it October 1st. You start pushing this stuff off, it's going to be hard to turn it back on after a while, because unless there is a bad reaction. Look, you didn't pay your taxes, and look at how bad things got, because we kind of need the money for the system to work properly. Okay, well, then I guess I have my obligation to pay taxes. But if you tell me I don't have to pay my taxes and the stock market keeps going up and everybody gets their job back and there's no problem, you're going to completely pervert the system. So what I'd like to say is that this government expansion, no matter how well-meaning it is, will continue to expand and expand until it becomes a problem. So when my friends at the Fed say, oh, well, we're going to do this with the government bond market, we're going to do this with ETFs, that's not going to be a problem for the market. Yeah, and it will be a pleasurable experience if you're right. And the demand will be not for you to stop doing it, but to do more of it. And if that's a pleasurable experience, you'll do more of it until you've gone too far. So we eventually will. Like you said, QE1 became 2, 3, which never went away. Now we're buying corporate bonds, we're buying ETFs, we're going to buy municipal securities. I don't know how these programs ever go away. Right. I don't know if they ever will go away. And that's going to be a big problem as we move forward.
What I'm thinking through in my mind here, and let me try to articulate this as well as I can. So we've got all of this money printing going into, let's call it in the form of MMT or helicopter money going to people. They like this. They want it to continue. Then at the same time, we have all these programs that are being set up where there's more bank reserves, and who knows if those are becoming deposits in the retail banking system, therefore increasing M2. And if we're getting helicopter money into at the average Joe and Jane, that most likely will increase velocity. And then you've got the Fed trying to peg the yield curve because they don't want interest rates to go up, because we know that if the 10-year goes up, let's say to 3-4%, then that almost has the same impact as the virus. You know, that's extremely damaging when you build an economy that gets addicted to 0% interest rates. But in order to do that, the Fed has to buy treasuries, so they have to become a bigger part of the market. Then you reduce liquidity in the treasury market, going back to the Bank of Japan. And if the Fed has to continue to buy to control the yield curve, is there a point where the Fed can't buy any more treasuries because the dollar funding markets need collateral? So they paint themselves into a corner and inflation takes off because you have all this increase in M2 and velocity because of the helicopter money. Sure.
We saw it last September with the repo market. You know, that what happened with the repo market is, in simply put, 2008, we have a financial crisis. One of the problems with the financial crisis was the banks over-levered. They went too far, most famously Lehman Brothers. And then, so for the last 12 years, we've been putting governors on the banks. You can't do this, you can't do that, you can't lever. And what's important to understand about that is it wasn't just the Fed that did it. It was everybody that did it. It was the European Banking Commission. It was the OCC, the Office of Controller of Currency. It was the Fed. It was the FDIC. It was the Treasury Department. You know, on and on and on. So we kept limiting the banks to what they could do.
Just to be clear to the viewer, you're talking about Dodd-Frank, the GSIB, and like Basel III, those types of regulations?
Yes. Okay. GSIB, the globally systemic important banks, Dodd-Frank. What I'm trying to tell the viewer is, it wasn't just the Fed that put together these rules. It was all kind of regulators that put together these rules. And we want to limit the banks, limit the banks, limit the banks. But what were we also doing for the last 12 years? Borrowing more, borrowing more, borrowing more. So the treasury market kept getting bigger and bigger and bigger, but we kept putting limits on the banks, and then it broke in September because the ability of the banks to expand to meet the ever-expanding treasury market and the ever-expanding repo market, they couldn't handle it anymore, and then the market broke. Then when the bankers came in and said to the Fed, too many rules, you want us to expand our balance sheets to meet these larger needs for borrowing, we can't do it. And the Fed said, okay, well, we'll suspend our rules. And they said, no, it's not just your rules, it's everybody's rules. And you don't have the ability to suspend everybody's rules. So that's when they came in with all these repo operations and everything else to try and artificially expand the market. All I'm trying to say is we have an example of that happening. It happened last year. So as the market continues to, go, we were going to continue to have these problems. The Fed will continue to try and push money into the system to try and meet these ever expanding problems. To that end, I've been one that's been very worried that on the back end of this, we're going to have a problem with interest rates going up, and maybe going up in a big way. What I mean by the back end, yes, I understand in the second quarter and the third quarter, we're going to have contracting GDP. We're going to have the economy going down. We're going to have maybe deflation happening in the immediate quarters, maybe year ahead. But at the other side of that, we've got two things going on at once. One, we've got a massive amount of borrowing going on right now. I started in the bond market. When I told you I worked in the beginning, I worked at, First Boston and Shearson Lehman Brothers. That was 1987 when I started. I was there around the stock market crash. That was 33 years ago. And for 33 years, people have, I was a young guy then when I started then. Now, 33 years ago, when people used to tell me almost from day one, there's going to be a crowding out. The government's going to borrow so much money, they're going to push up interest rates. And for 33 years, I kept saying, that's not a thing. And it wasn't a thing. Well, welcome to the post-virus world. Now it actually might be a thing, because the amount of borrowing that the government is going to do now, these are numbers that are hard to understand. In January, when the Treasury comes out and says, here's our borrowing needs for the first quarter, $360 billion. Everybody said, holy crap, 360 billion. I thought it'd be 340 billion. And you put 360 billion of borrowing, and then the second quarter numbers come out, 3 trillion. Wait a minute, how am I supposed to process that number if I thought 360 was a big number over 340? Now we're at 3 trillion. So the amount of borrowing that is going to come down the pike is going to really stress the financial system, I think. And that can be problematic. One of the reasons I've talked about this repeatedly, since March 13th, when the Fed formally restarted QE, they have bought $2 trillion with a T dollars of securities, another number no one understands. They bought $2 trillion worth of bonds since March 13th. March 16th, the 10-year Treasury was 72 basis points. Tuesday, it was 72 basis points. And I said, if this market was anywhere near normal, and you said, here's a normal market, and the government prints up $2 trillion and buys bonds, where would the yield be? Zero, if not negative. You would have had the biggest rally you've ever seen. Why didn't we have that rally? Because away from the Fed, everybody's liquidating. And the reason everybody's liquidating is they see this massive deficit coming. And I think that on the backside, they see inflation. If inflation is the intersection of aggregate demand and aggregate supply, what do I see coming on the other side of this? Aggregate supply is going to go down. If we're going to have 20% unemployment, we're not going to be making as much stuff as we used to make.
So everyone misses the supply side of the equation.
Right.
Everyone. They just focus on
demand.
demand.
Supply is going to go down. Everything is going to be less of everything. Aggregate demand. If we keep giving everybody $1,000 a week, you're going to keep wanting to buy stuff. That's going to give us inflation on the other side. We're going to keep that market out of balance. So the fear of way too much supply and inflation, I think, is really pushing up interest rates. Because like I said, incredibly, I think if this market was anywhere near normal right now, interest rates would just be plunging and plunging. They'd be where the German 10-year Bund is at minus 50 basis points, or they'd be where the Japanese 10-year is, somewhere below zero. They wouldn't be stalled at 60 or 70 basis points like they have been for 2 months. So I already see those problems manifesting themselves, but I understand I work on Wall Street, and I know how problems work on Wall Street. You identify a problem, and people look at their watch and go, well, it's been 8, 9, 10 seconds, and it hasn't blown up, so I guess you're wrong. And that's kind of the way everybody works with this stuff until it then becomes a problem, and they go, oh, I guess it really was a problem after all. People get very impatient when you tell them that there's a problem, but I still think that this market is not really behaving properly given what is happening to it and the lack of what's going. In fact, going one step further, I think we already have yield curve control. I think that it's a de facto yield curve control. Every week, the Fed adjusts the amount of buying that they do. Yield curve control, let me give you a definition of that. The Japanese modernized it in 2016. They said, we're going to peg the 10-year yield at zero, a zero yield. We will buy or sell as much as necessary every week to make sure that the yield is at zero. That's yield curve control. And the problem, like I said, is, well, maybe the week you did it, it was fine to be zero. But if you do that every week, if you're saying that the proper interest rate every week for 4 years is zero, eventually it's not going to be. And that's when volume disappears and everybody just leaves the market. I think for the last couple of weeks, for the last 2 months or so, we've got a de facto yield curve control in the US. We seem to be between 60 and 70 basis points on the 10-year yield. It doesn't go anywhere. Its volatility measures are plunging. The volatility measures of the stock market and commodity markets and FX markets are not plunging. And so there's a big disconnect between what's happening with the bond market and what's happening with everything else. But I'm pointing out a disconnect of a lack of volatility. So everybody goes, well, it can't be that important because it's a lack of volatility disconnect. But it is. It's a signal that it's telling us that the market is not right.
Yeah, and the lack of volatility is potentially a signal telling us that the Fed is getting a lot closer to the BOJ, meaning that they're a lot bigger portion of the market, and it's just not trading like a healthy market would.
Right. I mean, they really are. Ken Rogoff came out today. He's a Harvard professor, and he's a big, let's call him an influencer in Fed circles. He's got a paper out that the Fed should be putting the funds rate at -3 right now. He's not on the Fed, but they take him very seriously as well. So this idea is still Nariel Narcha-Kalota, who's the former Minneapolis Fed president. He's publicly called for negative interest rates as well too. So these distortions are out there. These markets aren't working right. And the more that I think they call for that, the more that they encourage the private sector to leave. The only reason the market is not going up in yield is the Fed is buying, but it's taking $2 trillion of buying just to hold interest rates steady. That sounds like the path of Japan. The private sector leading, the public sector is taking over the market. Eventually, if you have that loss of a capitalist market to seek equilibrium, you're going to get malinvestment. And look at the Japanese economy. What is it? What is the one constant in the Japanese economy? Lousy growth. It can't ever seem to get out of its own way. And that's what I'm really afraid of, that the Fed needs to get out of this. But the only way I see them getting out is a toxic reaction to what they've been doing that burns their fingers and says, all right, you got to leave. I'm afraid that the stock market keeps going up, everything keeps holding together, and the encouragement of, yes, Jay Powell, you're our savior. Please do more of this, and please do more of this. And they'll credibly tell me, but what they've done is not been over the top. Yeah, well, we'll do more of it. We'll eventually get there then. We'll just keep expanding this thing until we do go too far.
Yeah, so how does that end game work? I mean, and the rebuttal, I think, Jim, people would say, okay, you're talking about Japan. They have low growth. They haven't seen a lot of inflation. So why can't we just send everyone $1 million and we don't ever have to worry about inflation? Because look what happened in the United States since 2008. And look what's happened in Japan. This inflation boogeyman is something that we just shouldn't be worried about. So why not just start UBI? Why not send everyone $1 million and into their checking account? We can all live happily ever after.
We're going to do that. That's exactly the road we're going down. We already sent everybody a $1,200 check. We're already giving them more money than they probably made. Not everybody, more money than they've probably made. Through unemployment insurance. We already have UBI being proposed in the Democrats' latest bill right now. A version of that is coming along as well too. But you're right. See, the problem is that's MMT. MMT, modern monetary theory, is, if I was to boil it down to a few sentences, is we will print the money for everything we need. We will do away with taxes, except when we get inflation. Then we bring back taxes as a way to drain money. So I like to say, in the current system we have, the Fed sets the funds rate. So interest rates go up and down to kind of regulate regulate inflation. In the MMT system, interest rates are set at zero. Tax rates go up and down to kind of regulate inflation as well too. So you're right. What will happen is, and that's why I'm saying we're going to MMT. We're already telling you don't have to pay your taxes. You don't have to, we don't have to pay them to July, maybe December. I don't have to pay my real estate taxes until later this year as well too. We're going to print this money. We're going to hand it to everybody. The end game has to be inflation, and it will be inflation, because if we do this and we don't produce inflation, we're not going to stop. We'll just do more of it. We'll hand everybody $2 million. And if that doesn't produce inflation, we'll hand everybody $4 million. And we'll just keep going until it winds up going too far. There is no way that we're going to say, okay, we did all these extraordinary actions, we fixed the market, now we're going to withdraw the troops back to the barracks. I'm all full of metaphors today. We're going to bring them all back, and we're going to stop doing it. Nope. Especially if Biden is president. If Biden is president, then he's already put AOC on his advisory committee as well. The idea that we need to have free health care, free college education, and we're just going to print the money to pay for it all, or borrow the money to pay for it all, will be unstoppable, because we just printed and borrowed 5 years of tax returns in 2 months. If this winds up not being a bad outcome, then we're going to wind up printing another 5 years worth and another 5 years worth until we go too far. The sooner we have a toxic reaction, the smaller it'll be. The longer we play this game, the larger it would be. I told you I was Johnny Raincloud on this.
Yeah, but the problem there, Jim, is that if we get this type of inflation, let's say it ticks up to 5-6%, or something like we had in the 1970s, the Fed can't come in Volcker style and take rates up to 18%, because the economy would just be crushed because of the amount of debt. In fact, I think Eric said that he heard a quote from Volcker before he passed away. Someone asked him if we could do today, and this was back in 2019, what he did in the early 80s, and he said, absolutely not. He said, no chance. There's just too much debt. I
agree. There is way too much debt, and there's this undying belief in the Fed. We're borrowing $3 trillion worth of treasuries. Why didn't the treasury market buckle under that idea? Because the Fed's here, and the Fed will print money, and the Fed can make everything, fix all of the ills in the marketplace. So there's this undying belief that the Fed can handle whatever problems we need, that they can regulate interest rates. What happens if interest rates start up because there's too much borrowing or inflation? The Fed will suppress them back down. And that's kind of a counterintuitive thing as well, too. So there's that belief in the marketplace right now that we could fix it. Look, that's what lifted us off the lows in late March. The Fed came in with a bunch of kitchen sinks they threw at the market in late March, and we've got this rally going. If you ask anybody on Wall Street, why did the market rally since the late March? The first reason they will give you most likely is because the Federal Reserve stepped in with its printing press. So there's this undying belief that the Fed can handle all of these problems. So you're right. We're not worried about rising interest rates. We're not worried about inflation, because we think the Fed can fix that. And it will only take a shaking of that confidence in central banking or central planning that is going to create some kind of a change in the attitude right now. But right now, everything's okay, not because the data says it's okay, not because we're going to have a 98% economy. We might even have an 85% economy, because the printing press is here, and the printing press is going to fix everything.
Yeah, it's just inflation is the kryptonite, because inflation takes away the printing press. So I want to be cognizant of your time, Jim.
I got some time.
I appreciate you being so generous today. But one question I want to make sure I ask you, because I think it applies to the majority of the people that are watching this video. I noticed, I think it was in your 90-minute or your 90% presentation conference call you did yesterday, but you talked about the risk parity portfolio, this typical 401k setup that every financial advisor out there suggests, of this 60-40. And you had these charts showing that this relationship between bonds and stocks most likely has changed. And if it hasn't changed now, it may change in the future, but they're not tied at the hip like all these financial advisors and all these baby boomers out there that probably have their portfolio set up this way actually think. So could you walk us through that? Because I think that's a very powerful warning for a lot of people.
The most basic relationship in finance is interest rates versus risk markets, the stock market versus the bond market. When interest rates go up or down, how do the risk markets respond to that? And I've argued that the driving factor in this, not only me, but others that have looked at this have come to a similar conclusion, is inflation. So go back to the 70s and the 80s and the early 90s. That I would call the inflation mindset period. We're always worried about inflation. So why do interest rates go up in the 70s, 80s, or 90s? Because there's a fear of rising inflation.
Right.
What does that do for risk markets? It depresses them. When you're relieved, oh, look, there's no inflation, rates go down and stock market go up. So interest rates and risk markets like stocks move opposite each other. You get to the late 90s around long-term capital, the Russian debt moratorium, the Asian financial crisis, and we have a sea change view ending with the tech bubble in 2000. Now deflation is the biggest concern and has been for 20 years. Why do interest rates go up? It is a relief of no deflation. That's good for stocks because deflation is bad for them. Why do interest rates plummet? It is a fear of deflation. So when interest rates go down, stocks struggle as well too. So they move together with each other. I've been arguing that starting about a year ago on the edges, but really since the virus hit, that relationship has gone away. There is no relationship now between stocks and interest rates. They seem to be random, or they're transitioning from one version to the other. Look, when you go from the inflation mindset to the deflation mindset, it isn't one day you flip the switch. I argued it took 4 years. That the stock bond relationship was random for 4 years. They seemed to relate, then they didn't relate, then they related. So we've gone random. So what does that mean short term? Your 60-40 portfolio. This is the driving thing that every wealth manager has. There are 36 million accounts in the United States that their money is being directed by a wealth manager. Why do you go to a wealth manager? Because you're afraid. You're probably in your 50s. You've probably seen 2000, 2008, and this is even before the virus.
Right.
You saw a 50% correction twice. You say, I'm afraid. I want to be invested, but I'm afraid. Because if you weren't afraid, you'd just go out and you'd buy double levered S&Ps and you'd be done. But so you're afraid. And so the answer that every wealth manager had for you was the 60-40 portfolio. 60% of your money in stocks, 40% of your money in bonds. Because the stock market goes up, you get depreciation. But when the stock market wobbles, the bond market rallies big, and that provides you with a natural hedge. And it worked great until around the fourth quarter of 18 and in 19, and especially fell down during the sell-off in February and March because the stock market tanked and interest rates didn't do a whole lot to help offset that pain. So what I've argued is, one, the 60-40 portfolio is now two random investments. They're not related to each other anymore. Sometimes both might go up. Sometimes they both might go down. Sometimes one will go up and one will go down as well. So that's going to cause a lot of consternation because it's the bedrock of wealth management is some version of the 60-40 portfolio. Risk parity is a version of that. Risk parity is the ability or the way that you would trade the stock market and the bond market against each other. The risk parity concept was popularized by Bridgewater and Ray Dalio, right, where they trade stocks against bonds. That relationship has not been working. That strategy has not been working as well, too. This can become very problematic as well because a lot of investors on both ends of the equation, bond investors that own bonds that will seek a little bit more risk or oomph in their portfolio, could use riskier assets because they believe there's a relationship between stocks and bonds. Stock investors that want to protect themselves could use the bond market as a natural hedge because they believe there's a relationship between the two. But if that relationship is gone and we're transitioning to an inflation mindset, for 2022, 2023, and we're in a no relationship environment, which is what I think we're in right now. It's going to take a lot of strategies Wall Street has. They're just not going to work properly.
I just did a video on the 1970s, and I didn't realize that. I found it fascinating that between 72 to 74, the S&P went down by like 60%, 60, while at the same time you had interest rates, or you had inflation, the CPI, up near 5, 6, 7%. So in that type of environment, you'd see interest rates going up and you'd see the stock market go down. In other words, you'd see bond prices go down and stock prices go down at the same time. So if you've got this risk parity portfolio that's nothing but bonds and stocks, that to your point, you've probably done extremely well since 1980, since we've been in a 40-year down cycle in interest rates, where the bond side of your portfolio over time makes money and capital gains, and then the stock side of your portfolio does the same. But what happens if we go to 1970s for the next 5 or 10 years, where both sides of the portfolio, the prices actually go down?
Yeah, that's going to be a shock for people, because what is the one thing on Wall Street, to show that you're pragmatic on Wall Street, what do? You're always bearish on bonds, because you always can say that the reason interest rates will go up is the economy's getting better. God bless America. So I'm bearish on bonds all the time. That is a way interest rates can go up, is that you just get very strong growth, and it forces real rates higher, and it forces nominal interest rates higher. But what we're talking about is the 70s way of rates going up. And that is that we get some kind of a stagflation, too much borrowing, too much inflation. Bond investors want to be properly compensated for it. And then you have interest rates go up. So I can't tell you how many times I talk to people in the institutional community, and they'll ask me, I've been a big bond bull until a few months ago, but since they've asked me about my outlook for interest rates, and I say I'm bearish on them, I think they're going to go up, and their reflex is, oh, good. No, they're not going up because we're going to get strong real growth. They're going to go up because we're going to have some kind of inflation risk, and we're going to have some kind of a liquidity premium that's going to have to be put in them, because you're going to be borrowing so much. That is going to be hard for people to kind of get their head around, I think, over time, is that why rates go up. They can go up for good reason, but they can also go up for an inflation reason too. And I want to emphasize again, this is the back cycle of this, because whether we get a vaccine or not, eventually we'll get herd immunity. Eventually we're going to, whether we get to 90% run through a bad recession, we're going to restart the economy. We're going to make an attempt to restructure the economy. I think that on the backside of this, we're going to find we produce less stuff, aggregate supply goes down, we keep handing people money and say, go spend it, keep boosting aggregate demand, and that's when we get the inflation. So it's not a story for this year. It's maybe a story for the second half of next year, and as we move forward from there.
Yeah. All right. I've got about 45,000 more questions, Jim. I could spend all day here, but in the interest of time, we'll stop it right there. For the viewers who want to find out more about what you do, I know your website is fantastic. You've got a ton of research on there. I cannot recommend it enough. What's the website? Where can they go?
Yeah. Website's biancoresearch.com, at Bianco Research on Twitter. And if you look me up on LinkedIn, those are the 3 platforms that I'm on. And I try to put out stuff to try and keep people apprised of what I'm doing. A lot of the stuff on the website is behind a paywall for paying customers, but there's a lot more stuff. I would start with Twitter. That's probably my basic public facing way that I go out there is by putting stuff on Twitter.
And I noticed on your website right now, you've got a free trial offer, correct?
Yes, we always have a free trial offer. Our basic business model is we sell research for a living. And so we're always looking for subscriptions. They come in one of 2 ways. Our institutional clients can pay us through the brokerage operation of Arbor Research through trading. or you could pay for it through a regular subscription level as well too.
Yeah. Yeah, but at the very least, I think they should go follow you on Twitter. If they like what they see, which I'm sure they will, then just go check out that free trial offer and take it from there. So, Jim, thank you again. I cannot wait to do it again.
Thank you.